my team members coming from all over. We had about 20 people on site, and we spent 2 days, 2 full days on site. It was an extraordinary effort and cost money and time. And so for us to not do the deal, it's a very disciplined decision to make. Hi, this is Garrett Lynch with Nighthawk Equity. And today we're going to talk about a deal that we actually didn't do because of the things that we found during due diligence. Now, something like this is very difficult to go down that path because you're putting in a lot of time, effort, energy, and money into getting your due diligence done and into buying a deal, only for it all to go away. And a lot of people get down the path and they don't actually move forward with a deal, but a lot of people also do move forward with the deal when they shouldn't. And that's what you want to avoid. So I'm going to go into a deal that we did not do recently, and it was a very difficult decision to make for the reasons I mentioned before, plus just the timing. There's not a lot of deals happening right now, and we had to be disciplined. We had to stick to our guns and not move forward with it. Now, I'm not going to disclose where the actual deal is specifically. I'm not going to disclose the name of the deal or any real specifics of it, because if it does come back around, we might still buy it. But I do want to share what our findings were so that you guys can go into your next purchase more informed, or your next investment more informed, and understand the things that need to be looked for when it comes to due diligence to make sure that you're buying an investment that's going to make sense in the long run. So first, I'm going to go into what I really liked about this deal. There were a lot of things. The background on this deal is that it had been owned by a previous owner for about 30 years. Somebody bought it and they wanted to buy it with a bridge loan, upgrade the deal, and then flip out of it and sell to someone else, which is a good strategy. It's a little bit tougher to pull off when you have a declining market like right now. Still, this particular owner that we were going to buy it from had done some decent work to the property, but not all of it, just enough. Took care of the deferred maintenance on the deal and did a lot of things like painted the outside, which takes time and energy. Rehabbed on a lighter side about half the units. They'd done some amenity upgrades to it. So it was in a good position to take it and further rehab it and get it up to the top of where it should be. It was priced well. We felt comfortable with that. We really liked the location. Was a particular place in Georgia. There's a lot of demand and not enough supply. There's a lot of growth drivers like jobs, new jobs coming in the area. The location specifically was just up and coming. You'd seen population double in the last 10 years, which is amazing. And we just really felt comfortable and confident with this specific location. Location's a really big deal when you're going into buying a property. You really have to look at the location. Our specific business plan in general is to go and find a junker property in a really good area and then bring the property up to the next level so that it's in high demand. So this fit perfectly into that type of business plan. Other things we liked about it had the tenant base on there that we really liked specifically. They were all paying on time for the most part. There was very little delinquency on site, which is always helpful. So it allowed us to size better on the loan. Looked like the property had been kept up and well maintained, and the staffing situation had been figured out over there, so it'd be an easy transition to take it over if we were able to retain the staff. So a lot of good things about this deal that made it worth our time. And so one thing I want to talk about is timing in general. We had the choice to do diligence on this site before we went under contract without any protections, or after we went under contract with protections. We chose to do it without protections, meaning if the seller was misrepresenting the deal and we wanted to not do it, all the costs would fall on us for the due diligence. And due diligence does cost money. You have to get a team on site to go through every apartment to make sure that the deal is what the seller is saying it is. So it can range anywhere from $5,000 all the way up to $15,000. Actually, higher than that, $50,000 is kind of the high. Ours was about $15,000, where we kind of fell on the radar with our costs is what we estimated. But it takes a lot of effort too. Like, I had to fly all the way into Georgia. I had my team members coming from all over. We had about 20 people on site, and we spent 2 full days on site. was an extraordinary effort and cost money and time. And so for us to not do the deal, it's a very disciplined decision to make. So next, what I'm going to do is get into some of the things that we found and why we ended up not doing the deal, even though we liked all these things about it. So the first issue that we found was something that we were already made aware of. We just had to cross-check and confirm what was being told to us. There's a specific type of piping that if you find it in a property, you really have to or it exists. In the past, we've just run away from the entire deal altogether, but it needs to be addressed. And that type of piping is called polybutylene. Polybutylene piping is something that runs in the walls. It's your hot and cold lines. And it was something that was used in the 80s through 2000s in different properties. And it was used by developers because it was thought to be a really up and coming and great type of material to use for plumbing. Well, what they found at a later date was that this actually wasn't the case, and that these types of piping that are made out of polybutylene failed often. They would burst in the walls, they would fail consistently. And so you have a lot of damage that's happening to your property over time and just in general. And so those lines need to be replaced. And that's a very important thing. So this person, the previous owner, knew about that and knew that their property wasn't going to be worth as much if they didn't replace these lines. So they started to do it. But they didn't just knock it out and be done with it. They did it slowly over time. They had a crew of 2 guys that went in, replaced each unit one at a time. So what I did is I already knew about this. And all we had to do was check to make sure the amount of units that they did were done correctly and that it was what they said as far as numbers of units that they did. So what I did is I hired a local inspector that specialized in polybutylene, and then I hired a plumber that specializes in replacements. And those two combined would give me the information I needed to basically figure out if this is what the seller is telling me. So we got into every unit. The inspector started out walking all the units, and then I brought in the plumber. What we found was that about 70% of the units were replaced. They were not done up to code. So the previous seller, before the one that had it now, just instructed the guys to do it as cheap as possible, but it wasn't actually up to code. So if an inspector came, they would not pass it. So that's the first thing we found. And we would have had to pay to upgrade all those units to get them up to code. The good news is that the lines were run properly in the walls. So you could typically tell if a deal has polybutylene plumbing by where the hot water heater is. So you go in the hot water, see what kind of lines are in there. And this specific deal, they were just tying the lines directly into the hot water heaters. They were not doing any kind of copper piping going out, which is something that you need to do with these replacements. So replacing the lines, polybutylene lines with CPVC, which is a way that you can do it. There's other versions as well, but that's one way that works. We found that issue. The next thing we had to check for was the amount of units. And so we found that they were actually misstating the amount of units that had been replaced. There were additional units that needed replacement. In addition to that, the main lines were not replaced, which is another additional cost. So the scope of the project had now increased, meaning we can't pay as much for the property unless these things are fixed, because it just won't pencil. It won't make sense. So this was a big find for us. Made sure that we addressed everything, but it was definitely something that we could solve. It wasn't too much. So the next thing that we found was most of the HVACs were 20 or 30 years old, which is kind of rare. When you find it, even with an older property, there's been replacements done over time. It's like these guys were just set on fixing these things over and over again. So we knew that there was going to be a lot more replacements than we had initially budgeted for. We typically budget for replacements on site depending on the condition of the HVACs. Well, there are a lot of HVACs that were pretty much all of them that were classic, like most 30 years old, and we didn't budget for that. So we had to add that into the budget and add it into a potential credit for the seller. Now, I don't think it's worth it to make sure that you get credits for every single little thing out there. It's cool if you throw the seller a bone. As long as you have contingency built in your model, you can typically cover some of those things. But the major things you want to address. We found siding issues, was wavy siding, different areas of the property that we weren't told about. So that was something that had to be factored in. We found retaining walls and concrete work that were messed up when we went through the property. There were a lot of old water heaters. We had to factor in water heater replacements more than we had thought. There are also a lot of gutters and downspout issues. When you have poor or faulty gutters and downspouts, it just causes an array of issues across your property. Those things back up with leaves. They can fall down. They're not channeling water properly, which can cause further issues and flooding in your apartments. So it's important that you have that set up correctly and you budget for it. And the last thing on the deferred maintenance side was fire code issues. So we found a lot of things on site that weren't brought up to code properly. And every year, at least in this state, there is a code inspection, and most properties have this. You have to upgrade things to the latest fire code situation. And so we not only found that their upgrades weren't done, but there were additional issues, just the hydrants and things like that needed to be brought to code. This all costs money. So the final thing, so these are all deferred maintenance items. Some of the things we decided, hey, this is probably worth a credit. Some were not. We didn't necessarily want to hit them for everything. But the final issue that we found, and this is a really good lesson, is I asked my construction team to measure the units to make sure that the unit size was what they said that they were. And we walked in and I immediately noticed, I'm like, these don't seem like they're oversized units, but who knows? Maybe they are. So my team measured them 3 times to make sure. And we found out that every single unit was 200 to 300 square feet off of what they were being told to us they were, and even what they were projecting them and selling them as to residents. So this is a big issue because if you add all of it up, it was somewhere in the neighborhood of 20,000 square feet missing from this, what they told us was going to be on the property. So then it's like, okay, well, what do we do? How do we reprice this? Every deal has what's called a floor. And so even if there's no people living in the asset, typically your valuations are done based on NOI, so your net operating income. Well, if there's 0 people in there, there's no net operating income, but that doesn't mean you pay 0 for the property. It means that there's a floor. So it's still worth something, right? So the one way we could look at it is, hey, if we reprice it based on what we were paying per square foot before, so let's say we were paying $1.50 a square foot, with the new findings that went up to $1.70, we just want to reprice it at the new square footage at $1.50. Okay, that actually took $3.5 million off the purchase price if we ran the calculation that way. So we said, probably not going to make sense. That's going to go beneath the floor where we think the floor is for this site. Not worth that much less. So then what we did is looked at the main issue, which is the real issue. If you find less square footage, why does it matter? You just can't command as higher rents. And so if you have an oversized unit and you think you can get top of market rents, now you can't. Now you're right in the mix with everyone else. You can make it nicer. You can still get decent rents, but it's not going to be as high as we had thought. So we repriced it based on what we thought the updated rents would be based on where other rents in the market were sitting. That shaved about $600,000 off the purchase price. This is a decent amount. Now, we felt confident asking for it because this was a pretty serious miscalculation on the seller's end, and they actually didn't catch that when they purchased it originally. We were the first ones to catch it. So remember, somebody owned this for 30 years. Some guy bought it from, didn't catch this, then we caught it because we were crossing our T's, dotting our I's on everything related to due diligence. So really he messed up when he purchased it from the 30-year-old seller because, it's a pretty big deal. So anyways, we compiled everything and we wanted to present it in a very professional way. We want to be timely with it. So we didn't take too long with putting this presentation together. And it was just a PowerPoint presentation that we turned into a PDF, and it outlined, hey, this is what you told us. This is what we found. And it went through each individual item. Some of the items we asked for credits back, some of the items we didn't, but it very simply explained each one of the issues. And the credits ended up being, and so the seller decided, I'm going to wait for the market to turn and I'm going to see if I can sell this thing again when things get a little bit better, but I'm not going to do this deal. Sorry. So because we weren't in a contract and we didn't want to put in a contract because of the timing around Christmas, people just disappear between December 15th through January 15th. It's good luck getting anyone's attention around that time. So it's difficult to raise capital. We didn't want to put in a contract. We ate the cost. It's $15,000. We ended up not doing the deal. It would have cost investors and ourselves a lot more if we had done the deal with all these issues. So if the seller is willing to reprice it, we'll come back in and no problem, let's do the deal. But because of these issues, we elected not to. It was a tough decision. I wanted to, we hadn't at this point done a deal in about a year because of the market in general. So there was a lot of incentive to go forward, but we had to be disciplined. We had to make sure that we were doing the right thing for ourselves and for our investors. So we ended up not launching it, not doing it. May come back around, it may not. I am completely comfortable with that decision. Hope you guys learned something about due diligence, the process. And if you guys want to find out more about what we do and see if partnering with us is in alignment with your goals, reach out to us at nighthawkequity.com. Click the join button, join the investor club, and just set up a call with us and let's have a chat and see if it's a good fit. And in doing so, you may find out that this is a great method for you to enhance your financial freedom and invest alongside the pros, aka us, that know what they're doing on this front of the business. Not everyone knows this. This takes a long time to understand how to go through this the right way. So again, nighthawkequity.com, click the join button, and we look forward to hearing from you. Thanks so much. We'll catch you guys next time.